Good afternoon. Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth, with you this afternoon. It is the 28th of October, market close. Thought I'd share some ideas as we end the month of October and we move into what will be an exciting and likely volatile November as we get into the presidential elections. So allow me to share the screen. We've got a few slides to go through, and of course, we always welcome your attention and of course, feedback. So here we go. Number two. Okay. So again, thanks very much for spending some time with us today. The macro backdrop. We had written this piece. It was a couple weeks ago, October 10th. You can find this piece on our website, alinewealth.com. And essentially, in there, we speak about the reasons why it's likely to expect a second wave of inflation. Now, markets, frankly, are not seeing this, right? They're not expecting this, and therein lies the potential for a surprise. And there's an historical precedence here that I think is important to understand. If you look at over the last 70 years or so, you've seen a second wave of inflation happening each and every time, likely, that we had hit 6%. So when we've hit 6%, which we did a couple of years ago, it comes back. And it kind of makes sense, and it's intuitive if you think about it, because folks that are managing their budgets are going to their employers and they're saying, hey, prices are still high. I need a raise in order to make my budget and make my household budget work. So that's the sort of traditional way of thinking about the second wave. There are three secular elements that we see as being potentially long-lasting, and which would give, I think, inflation a bit more room to grow over the next, say, several years. First is, we call them the three Ds. The first is deglobalization. It's clearly becoming more difficult to arbitrage away the cost differentials between production at various different countries. We're not even talking to them anymore. So you remember a lot of the disinflation that we saw in the 1990s was due to the emerging markets. And today, that is not the same place as it once was. And our relationships there are not the same as it once was. So that's a big difference. The second D is decarbonization. As I've said many times, we're going to save the earth, a noble goal, but it comes with a price tag. And that price tag is likely to be pretty huge. And then lastly, deficit spending is our third D. Folks, we got too much debt, and it's going to cost a lot to service that debt, and that is in itself inflationary. So we will expect to see a potential second wave, and that, I think, is an important area to think about. I don't think its inflation genie has been vanquished forever. I believe it's lurking. Let's move forward. Here's the debt. We talk about this every time. It's huge. It's a problem. It's where I see the next financial crisis to be born, is in the concept of our tremendous amount of national debt. And the servicing of that's become much more expensive as of late, with interest rates going higher. And so now we see, as you can see from this chart here, this little leg up in the cost of the debt. And of course, if inflation second wave, if it stays perniciously high, we should see this going to continue to go higher. And therein lies the issue with this, with the debt. It's not so much the amount. The amount is massive. I get it. But if rates were back in the old days of 1% or even zero, you could see how that would not make that much of a difference as a reserve currency as we are. It makes a difference when your servicing of that debt becomes almost equal to our defense budget. That's when things get crowded out, and that's when things have a problem. Here is the debt versus gold. So I say, is gold a good hedge against inflation? We've been holding a small piece of gold for years, and we still do. Some internals, lest you think that it's a good idea to have all your eggs in one basket. That's certainly not the case. The first rule of investing has always been, and always will be, to spread your assets, to asset allocate. this is a great slide because it looks at the lost decade, the 2010. As you can see here, the S&P and growth, or the Russell growth, it was down. The Russell 1000 was down over those 10 years. It's very rare to see markets down over 10 years, but here you go. And then what's done well in that same period of time are these asset classes, which are the international and the emerging markets. So if you had none of this and only this, as many folks might have today, given the flip side where these asset classes have not done well in the last 10 years and these have, you can see the situation. So this is why we want to stay somewhat balanced across a multitude of sectors. Speaking of balance, concentration risk is a big concern of ours. The 10 largest companies in the S&P 500, roughly 36% of the entire S&P 500, which basically means the rest, the 493 or 490 in this case stocks, have a much smaller degree over each of them have a much smaller degree of impact. So this is concerning. This is a slide just to throw in there about housing. Home sales look to be an opportunity because there's a supply issue with the homes that we need to fill. However, I think this is the bigger position, is if we do see interest rates staying stubbornly high, and that translates to higher mortgage rates that may curtail new housing starts. We do a fair amount of work, as you know, at Align Wealth on the intersection of valuation and opportunity. On the valuation side, it keeps us honest, it keeps us real. We're always looking to say, hey, what are we paying for that? We believe that is the most important factor when one looks at an investment opportunity. What's the cost of entry, so to speak? And so here we look at a couple of different metrics. We have the book value at stratospheric levels. We have the CAPE, that's Professor Schiller, his work, which is the cyclically adjusted PE ratio, and here again, elevated, right? In this trio, we'll see the share of the S&P with price to earnings ratio under 20 times at an almost all-time low, and those that have above 30, very high. And this particular graph shows a similar pattern. So there are few and far between are there opportunities, but that's what the opportunity for us is to do the heavy lifting of analysis, to do the search, to do the screening, to find those situations that may not be front and center, but present themselves as forgotten and unloved, but an opportunity. Buying low is certainly a good idea. And here's the PE ratio for the S&P since 1995. You see the sort of average here and where we are versus that. And here are the two other peaks. And we know what happened in each of the other cases. So let us be mindful to the fact that we are not cheap here. Doesn't mean that the markets are going to go down. It simply means that we should be careful with our capital and look to invest in investments that are well positioned and have a cushion or as it was Buffett likes to say, margin of safety. Okay, on the opportunities side, we see a few. Here's one that looks at data center growth. Here's this AI revolution. Well, one way of playing it is looking at energy demand. Another way of playing it is also HVAC demand, because you got to keep those data rooms very cool. But you need energy, bottom line. And this shows that how, what date is that? 2030, we're going to have sort of like six more New York cities added to, I'm sorry, three more New York cities added to the output. That's pretty substantial. Another slide that shows the growth, 117% for the balance for the next couple of years. That's it, for global electricity demand. So this is an area theme that we're looking at. But again, may not buy the actual companies in that sector, but some of the picks and the axes, if you will, the companies that have an extension to that. Think copper, think think HVAC, think energy. Um, Here's a move to net zero, another one of our themes. And here again, the takeaway is we'll fix it. I believe strongly in innovation, and we'll fix it. We'll bend that curve. It's going to be expensive. We do see some opportunities internationally. Those markets are fairly cheap versus US. So there is some opportunities that we see in the EU, blue chip based companies that are trading at a fraction of the US counterparts. Many of our listeners and clients have known for years we've been a strong advocate and proponent of water investing, compelling economics, increasing demand, decreasing supply. You've got a situation where you have the inelasticity of demand. So no matter what the price is, the demand keeps going higher because you need it. You can't live without it. There's no substitutes, right? So great, compelling economics, a multifaceted sector with, from infrastructure to EPA, as you can see here, estimates 600 billion is needed over the next 20 years. Can you imagine how much capital is coming into those companies that are in this industry? Testing, PFAS, PFAS, big deal out there. Cleaning up the PFAS in our water is going to be $1 billion per spend by 2030. So lots of opportunities for those companies that we've studied over the last 20 years that now have a lot of wind at their back. Speaking of wind, you have HVAC systems as well, and that's another big potential. There's a water component to that as well. So some opportunities. Okay, now, if you think that comprehensive fiduciary-centric wealth management is all about just knowing the markets and buying the right investments for your clients, that's not all of it. It's a good part of it. It's a critical part of what we do at Align Wealth. It's where we spend a lot of our time, but it's not everything. And this slide will speak to the three parts as we see it of wealth management. The first is this investment consulting piece. You've got to understand the markets. You need to understand how to analyze companies, how to analyze investments. That's, prima facie. You can't play in this game without that. That's critical. Number two, though, is this notion that advanced planning is a critical component. We do a lot of that for our clients at Align Wealth, wealth enhancement, planning, retirement planning, college planning for kids, wealth protection, and of course, philanthropic and charitable planning, getting the legacy part of a family's wealth in order. And then the third piece is, I guess, part of what we're doing today is communicating with our clients, exhibiting proactive empathy, as we like to say, showing them that we care, we're watching out for them, and we're doing it in a proactive fashion, not just a reactive fashion. Speaking with their other advisors, be it CPAs, attorneys, bankers, etc. Giving the client a full, comprehensive experience so they know that we are watching things carefully for them. And then finally, I'll leave you with this, folks. I'm sorry for the short nature of this call today, but this is an important piece. This is our second opinion service. So if any of you have portfolios that you're not quite sure what's going on, how they fit into your plan, we're happy to review them, to study how they interface with your current portfolio, or as well as your overall plan. And it very well may be a good fit. In this first box, we talk about that. It may be perfectly, and we would tell you that, but there very well may be gaps. And if they are, we're going to tell you that as well. Again, we're here to serve. You're our clients. This is what we do. And so wishing you a happy end of October. Enjoy the great weather that we've been having here in the Northeast. I'll stop to share. And by all means, stay in touch. If any questions or comments, please feel free to give us a call. Thanks very much.